Okay, so what happens to your money when a crypto exchange just vanishes? It's the billion-dollar question that's been keeping investors up at night. And right now, there's this massive battle brewing over who you can actually trust with your digital assets. You've got the old school banks on one side, the crypto world on the other, and smack in the middle are the regulators, about to make a decision that could really change the entire game. And this quote, it comes from a letter that a bunch of major banks sent to the SEC, and it just perfectly nails the problem we saw with firms like FTX. The keywords to focus on here are commingled and misused. Basically, it means customer funds got tossed into the same giant pot as the company's money, and once that happens, well, it becomes incredibly easy for things to go wrong. It's a total breakdown of the most fundamental rule in finance, and it's exactly what the traditional banking system says it's designed to prevent. So, how does the traditional system actually stop that from happening? Well, the banks will tell you they've got a time-tested solution, something they call the gold standard of custody. And the whole idea revolves around having a special, highly regulated guardian watching over your assets. And that guardian has a name, a qualified custodian. Now, this isn't just some fancy marketing term. It's a specific designation for an institution, usually a bank, that is legally required to do one thing and one thing only: keep your assets safe and totally separate from its own. You can think of it as a legal and financial firewall protecting your investments. And if you want to get a sense of just how much trust is placed in this system, just look at this number. That's $234 trillion. That is the amount of money and assets that traditional bank custodians are already protecting. It's just a mind-boggling figure that shows how deeply this model is woven into the fabric of the global financial system. So how does this all work in practice? Well, that trust isn't built on wishful thinking, it's built on three really core ideas. First, you've got segregation. This just means your assets are in their own separate vault, never mixed with the bank's money. Second, separation. The people who guard the assets are completely separate from the people making investment decisions. This is huge for preventing conflicts of interest. And third, proper control. The custodian has the keys, and they can't move your assets unless you, and only you, give them the explicit instruction to do so. Put all that together, and you get something called a bankruptcy-remote shield. And this is the real magic right here. It means that if the bank or custodian goes belly up, your assets are safe. They can't be touched by the bank's creditors. It's kind of like having a safe deposit box. Even if the bank building itself has a catastrophe, the stuff inside your box is still legally yours. And honestly, this is the exact piece of the puzzle that was missing for so many investors in the recent crypto collapses. So this brings us right to the heart of the debate today. You've got the banks with their gold standard on one side, and on the other, you have the way things have often been done in the crypto world. It's really a tale of two completely different philosophies for handling your money. And this table really lays out the differences in black and white. You look at the bank custodian column: heavy-duty regulatory oversight, legally mandated asset segregation, and a clear process if something goes wrong. Then you look at what the banks call the structural deficiency on the crypto side. Regulations can be all over the place. There's a documented history of funds getting mixed together, and if a firm fails, well, getting your money back can be a nightmare. From the bank's point of view, it's a no-brainer. The crypto world might argue that their way is more innovative and less restrictive, but you can't deny the risks are there. And the banks, they're not shy about pointing to their track record. They say, look, we've been doing this successfully for over 80 years. Through market crashes, recessions, and huge technological changes, they've kept client assets safe. In fact, in their letter, they say they don't know of a single time a client has lost assets because a bank custodian failed. Not once in 80 years. Which brings us right back to today and to the SEC. As the top regulator for U.S. markets, they're stuck at a major crossroads. They have to decide how these old-school, long-standing custody rules should apply to this brand-new world of digital assets. And whatever they decide is going to have massive ripple effects. So it all boils down to this one really critical question. Should crypto firms get to play by a different set of rules? Rules that might be more flexible, but also potentially a lot looser? Or should there be one single high standard for anyone who wants to hold other people's money? Okay, so with all that as the backdrop, what do the banks actually want the SEC to do? Well, their letter pretty much lays out two big demands for how crypto custody should be regulated from here on out. First step, they're calling for equal standards. Their argument is simple. If a crypto firm wants to be a qualified custodian, then it has to meet the exact same tough requirements that banks do. No shortcuts, no bank-light version. And second, they're saying no self-custody. This means an investment firm shouldn't be allowed to hold its own clients' assets. They argue that having that separation is just a non-negotiable guardrail to prevent fraud and massive conflicts of interest.
So why are they pushing for this so hard? Well, the banks claim this isn't about trying to kill innovation. It's actually about building a solid bridge so that mainstream finance can finally cross over into crypto. Their take is that the big money, we're talking pension funds, endowments, major corporations, they're all just waiting on the sidelines. They won't jump into the crypto pool until they know these basic, time-tested safety nets are in place. For them, this is the only way the market truly grows up.
And that leaves us with the big, open question at the heart of this whole debate. Is this gold standard of custody an absolutely essential protection that the crypto industry desperately needs to mature? Or is it just an old-fashioned system that's going to choke the very innovation that makes digital assets so revolutionary in the first place? The way regulators answer that question is pretty much going to define the future of money.